What's up everyone, and welcome back to the Web3 Daily. Let's be real, looking at the charts, today is a bit of a downer. Bitcoin was wrestling with that $110,000 mark for a while, but it just couldn't hold on and ended up taking a step back, now hovering around 109K. Naturally, that pulled Ethereum back from the $4,000 level too, and the whole market just feels a little sluggish. I find this kind of price action to be the most grueling. There's not enough momentum for a real pump, but there's just enough support to prevent a serious dump. It just grinds back and forth, really testing your patience. But have you noticed, beneath the surface of this seemingly dull market, the undercurrents are churning. Some old-school internet giants are gearing up to enter the game and issue their own stablecoins, and that's a pretty big deal. So today, we're gonna break down who's about to stir the pot in the stablecoin space, what new tricks those Wall Street guys are cooking up, and what major move the DeFi OG Aave has up his sleeve. And as always, remember that all investing carries risk, especially in an uncertain market like this, so trade cautiously. Alright, let's dive into the news that honestly surprised me the most. Guess who's gearing up to shake up the stablecoin scene? It's not some Wall Street fund or another exchange. It's Cloudflare. Yeah, you heard me. The same tech giant that provides CDN and security services for like half the internet. When I first saw this headline, my immediate reaction was, what are they doing jumping into this space? Why would an internet infrastructure company suddenly decide to issue a stablecoin? What's the play here? But after digging into their announcement, I realized they might be playing a much bigger game than we think. They're creating a stablecoin called NET dollar, which they say will be fully backed one-to-one by US dollars. But the key is, their goal isn't to take market share from Tether or Circle, nor is it for us to trade on exchanges. Their ambition is aimed at what they call the agentic web. To put it simply, they envision a future where countless AI agents operate online, automatically handling tasks for us, booking tickets, processing data, making payments. So how do these AIs settle transactions with each other? They can't exactly swipe a credit card. Cloudflare's plan is for net dollar to become the internal settlement currency for this AI to AI economy. Just think about that for a second. If they actually pull this off, it completely changes the stablecoin game. They wouldn't be competing with existing stablecoins on the same playing field. They'd be building the fundamental payment rails for the future AI economy from the ground up. This means that as soon as the AI agent economy takes off, their net dollar inherently becomes the standard. And let's not forget, Cloudflare is a massive gateway for internet traffic, giving them a huge natural advantage in driving adoption. The potential here is on a whole different level than just building another payment app. Besides tech giants like Cloudflare making their strategic plays from the outside, the road connecting our world to Wall Street is also being paved bit by bit. The asset manager Hashdex just made a move that might seem small, but I think has some pretty deep implications. You know their crypto index ETF? It used to hold the usual suspects, probably just Bitcoin and Ethereum. Well, now they've officially added XRP and Solana to the mix. You might be thinking, so what? They just added a couple more coins to a fund. What's the big deal? The key here isn't times which times coins they added, but times why times they were able to add them now. Behind the scenes, a regulatory rule at the SEC has quietly loosened up. Previously, if you wanted to create an ETF for a new crypto asset, the process was incredibly complex, with each one needing separate approval. But now, the SEC has approved something called a generic listing standard, which basically opens a side door. It means that if a particular coin's futures product is already trading on a regulated market like the CME, the process of including it in an ETF gets a whole lot simpler. Once that door is cracked open, it makes everything that follows much easier. It signals that, in the future, we're likely to see a growing number of compliant financial products that include a variety of major altcoins, especially for blockchain like Solana, which already has a lot of institutional eyes on it. This is like getting another ticket to be included in Wall Street portfolios. This isn't just about a new channel for capital inflow. It's about the fundamental classification of the asset. It's another step in moving these major coins out of the high-risk speculation bucket and into the investable asset bucket. If companies like Hashdex are working to expand the breadth of compliant products, getting more coins on Wall Street's radar, then a titan of BlackRock's scale is starting to get creative with depth. We all know how wildly successful their spot Bitcoin ETF, IBIT, has been. But clearly, they don't think just letting clients buy and hold is enough. It recently filed for a new product, a Bitcoin Premium Income ETF. Premium income, so where does this extra income come from? I understood it as soon as I saw the filing. they're running a covered call strategy. In simple terms, the fund holds Bitcoin assets, but at the same time, it continuously sells call options on Bitcoin in the market. The buyers of these options have to pay a premium, and that premium becomes extra income for the fund. The fund then distributes this income periodically as dividends to the ETF holders. Now, this product is fascinating because its target audience is likely a completely different crowd from the IBIT buyers. People buying IBIT are bullish on Bitcoin's long-term potential. They want the returns from capital appreciation. The target clients for this income ETF, however, are probably more traditional investors seeking stable cash flow, like some pension funds. They might not expect to capture all the profits from Bitcoin doubling in price, but they're more than willing to sacrifice some of that potential upside in exchange for a consistent, stable stream of cash every month or quarter. What does this signal? It signals that BlackRock is no longer content with just serving high-risk appetite, offensive investors. They're now using products like this to attract the more conservative, yield-seeking defensive capital. Bitcoin is slowly evolving from a simple speculative instrument into an underlying asset that can be used to create a whole suite of different risk-reward products, and that is exactly what Wall Street excels at and wants to see. Alright, after covering how Wall Street is getting creative with Bitcoin, let's bring our focus back inside the world of DeFi and see what the OG projects are planning. Aave, the undisputed king of lending protocols, just released the roadmap for its next generation, V4. I feel this is a pretty critical move because it basically reveals a major judgment call from Aave about its future direction after surviving so many market cycles. I took a look at their plan, and let's skip over the deep technical details, like their full migration to a new tokenized vault standard, which will boost the protocol's efficiency and composability. What really caught my eye was their strategic shift. Over the past few years, we all saw Aave expanding like crazy across various layer 2 seconds, deploying here, deploying there, as if they had a fear of missing out on any ecosystem. But in this V4 plan, they've explicitly stated they are going to make a strategic contraction. For those L2 deployments that have underperformed and haven't brought much real revenue to the protocol, they might just cut them loose. Their future focus will be recentered on the Ethereum mainnet and a few other core high-performing L2s. When I saw this news, my first thought was, we gets it. A few years back, when the multi-chain narrative was at its peak, the prevailing sentiment was to cast a wide net and be on every chain. But now that the tide has receded, a project of Aave's caliber is cooling down, and realizing that ineffective expansion is just a drain on development and operational resources. Consolidating their limited energy to focus on the core battlegrounds that generate real profit is likely the true strategy for surviving market cycles. So you see, whether it's Wall Street on the outside or these veteran DeFi protocols on the inside, it seems everyone is simultaneously getting more pragmatic, shifting from the phase of selling grand visions to figuring out how to generate cold hard cash, while the old guards in DeFi are starting to think about contracting their fronts to focus on their core on a completely different track. The power of the national team is, conversely, accelerating its expansion. I'm talking about central bank digital currencies, or CBDCs. Recently, China officially launched a new digital yuan operations center in Shanghai. And I don't think this should be viewed as just another run-of-the-mill financial news story. According to the official announcement, this center will primarily handle two business areas. First, building a cross-border payment platform. And second, establishing a blockchain services platform. We've been hearing about the cross-border payment goal for a long time. It's all about finding ways to get the digital yuan used more widely in international trade and settlements. But what's more interesting is the latter part, the blockchain services platform. The announcement mentions using it to explore the implementation of applications related to digital assets. Now that's something to chew on. What exactly does digital assets refer to here? Does it mean using the digital yuan to trade certain already compliant on-chain assets? Or does it mean they're going to leverage the digital yuan payment system to build their own permissioned chain for registering and circulating specific real-world assets, what we often call RWAs? The potential here is huge. When you look at these two initiatives together, you see a clear strategy. On one hand, making it easy for the money, the digital yuan, to move abroad, and on the other, enabling assets, these so-called digital assets, to circulate efficiently and securely within this system. This is clearly about laying the foundational infrastructure in advance for a much larger scale digital financial future. And while this path is driven by a completely different ideology from the decentralized crypto world we operate in, you have to admit, when a state machine gets serious about deploying blockchain and digital assets. The resources it can mobilize and the speed at which it can move could be beyond what many of us imagine. Just now we talked about how the national team is building its digital asset system from the top down. Well, in our decentralized world, the bottom-up exploration of RWA has also come up with some new tricks. Recently, an RWA project called Backed successfully tokenized two very familiar traditional assets on the Avalanche blockchain. One is the Nasdaq-listed Coinbase stock, and the other is the S&P 500 index. Now, bringing US stocks on-chain isn't a new concept. Other projects have done it before, but what's interesting this time is that they've really started to play with the composability of these tokenized assets within DeFi. For example, you can now trade these tokenized stocks on a decentralized exchange on Avalanche, just like any other crypto asset. But the more crucial step is that you can now use these tokenized US stocks as collateral in lending protocols to borrow stablecoins or other crypto assets. When I saw this, I felt that the RWA sector is finally starting to feel crypto native. In the past, many so-called RWA projects were just creating a simple digital registration of a real-world asset on-chain. You couldn't take it and participate in complex DeFi protocols. It was just an isolated digital certificate with very poor liquidity. But now, when you can use a tokenized S&P 500 index to get leverage, to do liquidity mining, to participate in all sorts of protocol compositions, that's when the vitality and potential of this asset are truly unlocked. It's no longer just a shadow of a traditional financial asset. It becomes a brand new, high-quality, natively yield-bearing collateral within the world of DeFi. Although the overall scale is still tiny, this is absolutely the right direction, allowing high-quality assets from the traditional world to seamlessly plug into our money-Lego world of decentralized finance. Okay, after covering so many topics about technology, finance, and the future, I want to use this last news story as a reminder, a wake-up call, if you will. We need to step back from all these high-level concepts for a moment and focus on the most fundamental and frankly brutal topic, personal safety. The US Department of Justice recently announced the case that, after I read the details, sent a chill down my spine. In Minnesota, two brothers planned and executed an armed kidnapping to steal $8 million worth of cryptocurrency. According to the official report, the victim was a successful early crypto investor. He ended up being targeted by these two brothers. They broke into his home at gunpoint and forced him to transfer $8 million in crypto to a wallet they controlled. After they got the funds, they abducted the victim and dumped him in a remote location. Now, while the case was eventually solved by law enforcement and the suspects were arrested, it serves as a massive warning for everyone in this space. Every day in our communities, we discuss how to avoid phishing, how to protect our private keys, how to spot smart contract vulnerabilities, all of which is on-chain, virtual security. But we often overlook the most primitive threat, physical security. When you inadvertently reveal your wealth on social media or expose your identity in certain offline situations, the threat you face may no longer be a hacker on the other side of a screen, but real, physical, violent crime. So, while making money in the world of Web3 is important, protecting our personal safety is perhaps even more crucial than protecting your private keys. The old saying, get rich quietly, is and always will be the unbreakable truth in our circle. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we're here, filtering through the noise to bring you the most important core insights from the Web3 world, the news that's closest to the money. We hope that by breaking down this curated content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive sign-up links for all the major exchanges down in the description box. These are special high rebate deals we've secured for our subscribers, and we hope they can help you save some costs on your trading. Let's all stay rational, move steadily, and get rich slowly together in the world of Web3. May everyone's crypto portfolio see steady growth. I'll see you all tomorrow.